Okay, and we are now live. We're here, Varsha Pasel joined with Snezhana Todorova yet again, here to touch on today's real estate market and our mortgage market, because let's be honest, that is top of mind
Everybody's
for
talking about it.
everybody. This is what we all talk about. It's like, oh, my mortgage is coming up for, even in friend circles, it's, oh, my mortgage is coming up for renewal in the next year. I'm so lucky I locked in. I'm not saying this, but that's the conversation. I wish I had locked in with COVID rates, but
Well, variable rate mortgage holder here, so
variable rate mortgages, that's right. It's not for the faint of heart. There's risk involved with that,
absolutely, absolutely.
but
Um,
something we were just chatting, Snezhana, that
mhm.
by 2026, almost all mortgage holders are going to see an increase of over 50% in their mortgage payment. That's a
Yes,
large sum of money to pay
absolutely,
every month, right?
absolutely.
Yeah.
Especially if for some clients that are in a low fixed rate mortgages and they have not proactively increased the monthly payment each year. This is what I do for my clients, by the way. We annually review the mortgage, and knowing that the rate at renewal might be much higher, we proactively try to increase the monthly payment by at least $100 each year. So by the time their mortgage is coming up for renewal, they should be somewhat accustomed to a higher payment. But that's again, that's a slightly different topic and a little different answer to your question. But the sad reality is that yes, almost 50%, give or take, it totally depends on their situation, but almost half of Canadians whose mortgages is coming up for renewal will see a drastic increase to their monthly mortgage payments, which will definitely impact their cash flow per month.
Oh my gosh, it's going to
It's
be a
something
harsh
I
reality.
encourage people to reach out 6-9 months prior to renewal, just so we can start the process of comparing options and talking about possibilities and what their budget would look like 6 or 9 months from now when they have to sign the renewal agreement. So we look at things as can they cut other expenses from their budget, which again, knowing how inflation was and food prices and everything, it's so hard to really spend less. But somehow, sometimes, believe me or not, like really, sometimes there is so many different ways of how we can, as soon as you see how much you spend per month and it's written down on every single expense, every single thing that you spend money on, your eyes would be like, oh my gosh, do I spend that much money really on things that you don't even realize?
This is
Now,
wanting to take me on so many different tangents, like this introduction itself, because I want to talk about, don't be afraid of looking and breaking it down. It is actually such a valuable exercise in looking at
absolutely.
your budget, looking at what you're bringing in on a monthly basis, look at your fixed costs on a monthly basis, look at your, disposable, like what are you just throwing money at, your subscriptions, like there's so many things. Just going back to mortgages specifically, but I think it's all encompassing, Snezhana, because it's not mortgage, house, right? It's okay, well, how do you budget for a house? How do you budget monthly payments? Is everything. Like, I
And
think people
especially if
just
you have kids as well, right? There are other expenses that are priorities and you're not able to cut them out as well. So
no.
it's
I would say, like, before we go into sort of the product types that are more popular today, maybe we need to distinguish the difference between the overnight, the prime rate, does it at fixed rates, variable rates, because the buzz, it's all the buzz, the buildup around this overnight rate and the change and the 25 basis points. And it's like, well, who's affected?
exactly. So that's the big question. And I find this is the most confusing topic for consumers because they hear all those rates in the media. This rate was down this much, and the overnight rate and the prime rate. But then when they look at their mortgage statement or they get an updated letter from the, let's say, variable rate mortgage holders, they receive an update from their lender. This is your new rate. And it's confusing because the Bank of Canada overnight rate right now sits in 4.5, where the prime rate is much higher, and also their variable rate mortgage that they pay, the interest they pay on the mortgage, it's even more, it's even higher. So to answer your question, basically think about the Bank of Canada overnight rate is basically the rate that the banks, they lend money themselves overnight. So they don't make money on that. Is basically when the transaction is complete, this is the overnight rate, which the Bank of Canada. This is why it's called the Bank of Canada overnight rate. Now, the prime rate is the rate that the banks use to determine their variable rate mortgages and lines of credits that they lend to consumers. So the spread between, of course, the overnight rate and the prime rate is mainly the profit for the banks, because at the end of the day, the banks are there to make a profit by lending money to consumers. Now, based on the prime rate, whatever their changes to the bank's prime rate, this is when the consumer's mortgage is affected, especially if they are in a variable rate mortgage. And further, to break that down, the variable rate mortgages could have either a fixed payment or an adjustable payment. So let's say I have a variable rate mortgage that it is considered an adjustable variable rate because my payment goes up and down every time when there is a change in the bank's prime rate. However, there are certain lenders who offer variable rate mortgages. However, the payment remains constant, that it doesn't change, and that could affect how much of the payment goes towards principal and how much goes towards interest.
Yeah. And is
And
that when, sorry, Snezhana, go ahead.
And I was just about to talk about the fixed rate as well, because fixed rates are not tied to the Bank of Canada overnight rate changes.
Before we go to fixed rates,
Mhm.
though, just to stay on variable rates, because this is a question that comes up quite often. In those two scenarios where you have an adjustable rate variable and a adjustable payment and a fixed payment, right? And you mentioned sort of the proportion that goes towards your principal pay down versus the interest. Is there one or the other that you're allowed to make those considerations, or can you make those considerations as to how much you want on either or? I mean, most people are only paying interest at this point in an adjustable rate mortgage.
At this point, you are not able to make consideration how
Right.
much, because it's something that the system automatically calculates for you when there is a change in the payment, because change in the rate, because again, the goal is the payment to remain the same if possible.
Right.
It's just more what we've seen throughout the last couple of years when the Bank of Canada was rising their interest rate. So did the variable rate went up so many times. I haven't even, I knew that at one point, but I believe it's 8 or 9 times.
So we've gone down twice, so we're just hoping for that.
As you mentioned, you're right, because some clients right now, they had to either make a lump sum payment or increase their payment so they cover at least the interest portion of the mortgage.
Yeah, absolutely. And there was something that just sparked a thought, again, to do with variable rate mortgages. Would you say that the person that is like, what is the benefit then, about the variable rate mortgage? Of course, the first thing that comes to mind is your penalty, right? And the ease in which usually you can get out of it. But is it someone who's less, like, just to have a handle on their monthly payments, that would pick a variable rate mortgage that has more of a fixed payment structure, or who can qualify for that?
Exactly. So it comes down to, so first of all, the variable rate, the first benefit of the variable rate was back when it was still, the prime rate was still low. Variable rates were really, really low. So people, they took advantage for maybe a year and a half or so, paying super low interest rates. And then, however, keep in mind that with the variable rate as well, there were some due diligence because we knew that the variable rate could change. So when the actual borrower paying, let's say 1.5% interest rate, we were qualifying at 5.25, which again, we wanted to make sure that the borrower has some buffer should the interest rates go up. We did not expect that variable rate will shoot up so high. Unfortunately, it did. And this is where the risk comes with variable rate mortgages, because you have the opportunity to save money when interest is low. However, I would say the variable rate mortgages typically is being recommended to borrowers who have higher risk tolerance, and they have some extra savings or extra some investments that are outside the mortgage or the down payment that put on the purchase, just so we know that they have stability in the payment. And should they resort to using some of their savings, they should be able to do so. Whereas fixed rates, I would say for somebody who is really a little bit less, they're more conservative, and they have more of a fixed income, I would recommend probably a fixed rate mortgage, knowing that they have the peace of mind, they can sleep at night knowing this is the payment they're going to pay for the next 2, 3, 4, 5 years.
Yeah. Oh my gosh, it totally makes sense, right? Like it's not so simple. It's not so simple that, oh, this person should definitely fall into the bracket of a variable. Oh no,
Yes.
this person should definitely, right? It really is, it has
So
to be customized.
different components. And last thing I just I wanted to mention to you. So back then, when variable rates were so low, actually many borrowers could maximize their borrowing power by getting into a variable rate mortgage, where they, because again, we do have a stress test, we have to qualify the application on the contract rate plus 2 percentage point higher. So for example, right now, for somebody who is looking to qualify for the absolute maximum mortgage amount, they most likely will be looking at a 5-year fixed rate, because right now the 5-year fixed rate is the lowest rate of pretty much many of the terms that are offered.
Oh, it is. It's well, I mean, we hear it all the time. Like,
exactly, because right now, exactly. Yeah. So for, let's say, a first-time home buyer, and they really want to stretch their borrowing power, and a fixed rate, a 5-year fixed rate would be the product to go. Then, of course, then would be probably going to ask me about that, and we briefly chatted about, let's say, fixed or a variable rate option at that time. 3-year fixed is very kind of popular, and I would say a good choice for borrowers who want the best of both worlds, meaning still a good, decent rate that doesn't lock you in for long, with, again, the anticipation that rates would be trending down. However, as we all know, we don't know how quickly or how low the rates would get. The only thing we know for sure, though, well, I wouldn't say for sure, but majority of economists predict that we will not see such low rates as we saw back in 2020, 2021, unless something unforeseen event happens. I wouldn't see rates low below 2% anytime soon, or even below 2.5%.
Gosh, I know. Looking back, I can't even. I can't even believe that we went that low. Like and it's great that people were able to capitalize at that rate. However, when you're overstretched, qualifying at 1.5%, and you can't hold on to your property anymore, given today's rate on a variable, it's a very sad story of people. I'm seeing, bank repossessions while I was showing homes recently, right? Which is very sad.
Something to, yes. So something just to add again, at the time when we had to qualify the variable rate mortgages, we even though the rate was 1.5, the borrower had to qualify at 525. However, the reality is that rates are 6.5, 6.75 right now. So even more.
You started on that with the prime rate being, when they set the prime rate, but that's not what most borrowers are going to see on their statement. Right? So what is it? And that's where your negotiation and your kind of looking at what lenders are offering, is that where it comes in? Because you're looking for the best offering out there for that.
Absolutely. Right? Again, and this is something that when we talk with clients, we try to, especially if they're open to consider variable rate option, we look at, here is the variable rate now, here what the payment would look like. Let's say if there is another cut and maybe variable rate goes down by 1 percentage point next year. But you're absolutely correct. So again, the overnight rate is not the rate that the borrower pays on their mortgage. Also, the prime rate itself, depending on the lender, the variable rates typically are set as prime rate minus some type of discretion. So let's say prime minus 50 basis points, prime minus 1 percentage point. So for example, I do have a variable rate that currently I pay prime minus 1 percentage point. So prime right now is, for the majority of lenders, is 6.7, which means that my net rate that I pay on the mortgage, the interest rate is 5.7 at the moment. And then, of course, if there are certain more cuts down the road, that will be good for all of us in a variable mortgage. It will
Let's
reduce.
get more of that.
Yes.
I almost think, there's this, before we touch on fixed rates, Snezhana, and like what affects fixed rate mortgages, I think it's a great segue to talk about like what's happening in our market currently.
Yes.
Today is July 31st, 2024, on the cusp of August. And, specifically for us in Guelph, Wellington, Halton, products are moving. However, there's definitely been sort of a decrease for June. They said it was about 9% of a decrease on sales price in Guelph in comparison to June of last year. That doesn't really shock me. We have a little more inventory, a little bit more of a pause, and very much a summer market here. But as much as, people are pausing because it's summer, which constantly happens, it's a very cyclical thing for us. I do feel that there's a little bit more because there's sort of a pause entirely, or just, what, I've had enough. I don't want to talk about the rate anymore. I don't want to talk about homes anymore. Just let me sort of think about something else. At least that's a conversation I'm having with people that I've been chatting with for months and months, right? And it's okay, I've just decided to focus on something else for a little bit because this housing situation, these prices still seem pretty inflated.
It's really stressful at times.
Very stressful. Homeownership is still a very valuable thing for most people, and especially when there's over 1 million immigrants that have entered our country in 2023. I find immigrant mentality and homeownership, they go hand in hand. Like owning a home, owning a piece of land is very much part of the immigrant story, I think, right? So I think there's still, right? There's still, and we both are immigrants, so we know.
Absolutely.
Right? But having said that, I do feel that if your product is, your home, I say product, but if your home is positioned well, marketed well, priced well, you're marketing it to the moon, like it should see traction. The goal is traction in today's market, right? It's not, can we sell this in 12 hours? We sort of need to be realistic about our expectations. And good homes will sell in most markets if you're aligned with the right people, right? So having said that, even though we've seen, and our average days on market in Guelph right now is about 22 days, which is not bad.
Not bad at all.
So that's just my little spiel on what's happening in the market, because that's the most immediate correlation. Okay, so we're talking about interest rates, and then, how does it affect housing, right? And affordable housing. Talking about affordable housing is a whole other topic, but we will save that for a different. I already feel like I can't believe it's been this long. So let's quickly touch on fixed rates, because it is important, the distinction between the two, and the right product for the person and their situation. They need to just reach out to their mortgage broker. Like,
absolutely.
That's the only way they're going to know.
So definitely different types of mortgages. We categorize them in different I would say buckets per se, because they're different depending on the down payment, the purchase price, and so on. But yes, so fixed rates, they're mainly influenced by the bond market, so especially the 5-year Government of Canada bond yield. So they're pretty much tied. And when we see the drop in the 5-year Bank of Canada government bond yield, that means that fixed rates are probably will be coming down slightly. It doesn't happen right away, of course. And sometimes with lenders, they are not in a rush to lower their posted rates or their advertised rates until there has been kind of a steady decrease in the bond yield. then they announce a rate drop, for example. However, that being said, it's important to also, of course, work with a mortgage broker who is experienced. So because we do have that ability to track where bond yields are, to see what other lenders are offering, and also negotiate the rate and work with the lender to obtain a rate discretion per se and have a lower rate secured. Not only that, but also, believe it or not, there's some lenders that once you have a mortgage approval, and let's say we have 3-4 weeks or maybe 2 months until the closing date or maturity date of the mortgage, depending on your mortgage product, you may not be able to request a rate drop if posted rates or advertised rates come down, whereas other lenders allow for unlimited rate drop requests, meaning that depending on the lender, let's say I monitor the rates for the client, and if there is an opportunity to secure a lower rate before closing with the same lender, we can go ahead and request that. So I feel like it's especially right now in this market where we see rates coming down slowly, especially for the fixed rates, not the variable, but fixed rate mortgages. It's important to track and monitor and see if there is an opportunity to secure a lower rate, maybe 5 days before closing.
Oh, wow. As close as 5 days before closing. See, I love that you brought that up, because that most people have the mentality, oh, I've already locked in. If I've got my pre-approval, I've already locked in. But there is an opportunity with the right lender to
Absolutely.
even still negotiate right up until the end, which is fabulous.
Without having to submit and start a new application with a different lender. Again, it all comes down to knowing your options.
Have you seen, now I just asked this out of personal curiosity, with each Bank of Canada announcement, the immediate focus is, okay, immediately it's, okay, variable rate mortgages. Is there any sort of offshoot, does it affect our fixed? I know that doesn't affect fixed rate, but is there anything that happens in and around the bond market every time they reduce?
Typically, yes. I would say the bond market responds, let's say if majority of economists are predicting, let's say more than 60, 70 or 80, 90% chance of Bank of Canada cutting the overnight rate, the bond yield market already responds to that a few days prior. And again, in order for the lenders to be able to really officially change and cut the rates, the bond yield needs to be kind of trending downwards for a certain period of time before they do that, because bond yield can go up and down very quickly. So they need to see a sustained drop in the bond yield market before official rate drop. But again, this is where it comes the additional rate exceptions and working with the lender, depending on the borrower's profile and closing date, by the way, to negotiate the rate. But in general, there could be some small correlation, and fixed rates could come down. But again, I'm talking about like very little discretion, nothing like 25 basis points cut for the variable rates.
Oh, no, for sure. See, so I would say, would you then agree that, I've been telling clients, get your pre-approvals, and it's usually 90 days, but you said start the conversation if you're up for a renewal 6 months in advance even.
Absolutely, yes. It's important just to know where the borrower is in terms of income and available funds and how they feel about their monthly payments. Do they have any outstanding debt other than the mortgage? Maybe a line of credit, maybe a car loan. Maybe we can try and consolidate other debts into the mortgage. And instead of simply renewing, perhaps we can increase the current mortgage amount to include the debts and even also extend the amortization, which at the end of the day gives them a lower monthly payment and a better cash flow.
And today, I know this is such a loaded question, but today, is there a product that is more favorable? Is it the 3-year fix? Like do people call and immediately they say, I want to look at this because I've been stuck in a variable?
Now, with the variable rate, one important thing to keep in mind is that the variable rate can be converted into a fixed rate pretty much at any time without a penalty, and majority of lenders offer that. But you're right. Like sometimes when I come in conversation with clients, sometimes they've done a little bit of research online. I mean, let's be honest, everybody does research online. They might have already an idea of what they want. So this is also another topic that we discuss. If they heard something that they think they might want to explore. But at the end of the day, this is something that I could say to all my clients is that, yes, we can talk about products, we can talk about interest rates, we can talk about, purchase price and so on. But until you see what the monthly payment is, you don't know. Because at the end of the day, 6 months, 8 months, 10 months after the closing, they will who remembers their rate? Like, unless right now, yes, because it's a hot topic, but for many borrowers, they simply forget the rate itself. They have to look it up, but they see the monthly payment coming out of their.
In all these years of home ownership, never have I ever been more fixated on a rate than I have been in the last 4 years of owning properties. Like, never. Okay. Other than, of course, when it comes time for renewal, right? And I love that you touched on purchase price. I think that is such a crucial part of this process of buying a home. It's okay, yes, the rate matters, but also negotiating the best purchase price. That's what you're literally going to be stuck with throughout the term of this mortgage.
Yes.
Right. So I think we need to pay a little bit of attention to what is that price like for you to hold on to, for so many reasons, from appraisal. Anyway, that's a whole other topic. Is there anything more specific we should touch on? Oh, and let me ask you about extending your amortization.
Yes.
Is that something you're speaking with clients about to help them manage their monthly payments?
That is one option that, again, works in their favor only if we're looking to, if we determine that the new monthly payment would push, really, they'll put the budget over limit and they're not going to be able to comfortably manage that. Right. Because with extending the amortization now, this is considered mostly a refinance transaction, not simply renewal, because it depends. If we extend the amortization and increase the mortgage as well, typically that's considered a refinance. But if we are able to keep the amortization as is, but also depends on the product they have as well, because again, there are different types: collateral charge, standard charge, depending on their existing amortization. Let's say if they are 15 years, probably we could look at extending it to 20 or even back to 25. Again, depends on the product that they have. But yes, we do consider that option.
Good. So then at the end of the day, it's have a really good relationship with your mortgage broker. Get a really good purchase price. There's so many factors here, but I think the number one thing is just stop fixating on all of these external things all the time and look at your budget, come back to your bank account, look at what comes into your bank account on a monthly basis and what can you and your family sustain, right? Mm-hmm. And then call your trusted advisor and take it from there.
And again, as I said, just something to put in quickly, like a 10 basis points difference in rate, depending on your mortgage balance, could be as little as $8 or $9 difference biweekly. So it's not, again, it's not a huge amount, but for some it is. Every dollar counts, of course, but that's why it's important to look at the payment and also the features of the mortgage, because you don't want to also get into a mortgage that has very high penalty let's say you go into a fixed rate, but then if rates come down significantly, if you want to break that product and go into a lower rate mortgage, you may be faced with a very expensive penalty that may prevent you from switching to a new lender with a lower rate. So that's important as well.
I'm sure that is an important step in vetting out the mortgage products, is figuring out the penalties, right? That's part of it.
Even though we cannot calculate to specifics, because there are a lot of course, banks make it so complicated to do that, because they take into consideration also what rates are at the time you will potentially break the mortgage. So it's a little more complicated, but at least the main formula per se, just to know, would I be okay? I'm willing to take this super low rate, but I'll be fine as long as I don't break the mortgage. As long as they're aware of that and they're willing to take on that risk, but have that rate secured, then absolutely As long as they're aware, I go with that.
Yeah. Oh my gosh, I could keep talking about the nuances of
Yes.
mortgages, no, truly, there's so much at play here. And I say
Mhm.
that because, like, if I'm standing in my buyer's shoes, or my just clients who are owning property, like, there's so many questions that come up naturally in conversation, and we've touched on so much of that today, Snezhana. But we're at the 30-minute mark, which I did not expect. So I'm gonna
No,
say,
topic that we can go on forever.
we could go on because it's everything when it comes to home ownership. So we will definitely come back with another mortgage update, but thank you so much, Snezhana, for
Thank
touching
you for
on,
having me again.
and breaking down sort of, overnight rate, prime rate, fixed rates. Sometimes everything gets lost in terms, and if you don't even get a basic understanding of what we're talking about, you need it, right? So thank you
Absolutely.
as always. I love having these conversations with you,
Thank
and
you. Yeah.
we'll do it again.
We'll speak again very soon.
Absolutely.